Warm welcome to eResources classes and thank you so much for joining this mini and micro webinar. Before we get into the discussion, let me just take a couple of minutes to introduce myself. I am CA Enraja, a chartered accountant by qualification, a teacher and trainer by passion, and teacher for 3 lakh plus students worldwide. I started my career as a banker with State Bank of India. Then after a period of 4 years, I got into CA practice. I had my practice for 7.5 years. But I realized my calling is teaching. I started focusing on teaching and training, and today, with the blessings of God, we have 3 lakh plus students worldwide. So now it's time for us to get into the session. Let's understand how drawing power is calculated in case of cash credit facility. Cash credit facility is basically sanctioned against inventories and debtors. So the inventories have to be divided into three. It is raw material, work in progress, and finished goods. Then debtors. Now within inventories, the unusable materials or obsolete raw materials have to be excluded, right? So we'll say excluding obsolete or unusable materials. So they got to be excluded, and same is applicable for finished goods also. Now we have to attach the respective value. So let me capture the amount over here. Let's say the value of raw material in stock is 100 million. Work in progress is say 25 million. Finished goods is say something like 75 million. And debtors based on their working capital cycle is at say 125 million. Now the bank will not lend against all these amounts fully, because the bank would expect the owner also to contribute, and that they ensure by having a provision for what is known as margin. So first let's say what is going to be the margin in percentage. The bank will not fund against the entire raw material. Bank would expect the owner to contribute at least 25%. Same is the case for work in progress and finished goods, and that is going to be the more or less a common norm. Okay. Now, if the bank is expecting 25% contribution for inventories, when it comes to debtors, bank would expect the owners to contribute even more, because these assets are highly risky than these assets. Of course, it is highly liquid, but it becomes untraceable many times. So bank will not be in a position to lend 75%. It means by having a margin of 25%, the bank is lending 75%, but the bank may not lend 75% against debtors. Bank may lend at a lower rate, let's say 60%. It means the bank would insist on a margin of 40%. So let's calculate the margin amount now. Okay, margin amount. So how it has been done? It's 100 multiplied by 25%, 25, then 25 into 25%, 6.25, 75 into 25%, 18.75, 125 into 40%, it's 50. Now from this amount, if we deduct this margin amount, let me just correct this. If we deduct this margin amount, what we get is going to be advance value. So let me capture that here. Advance value. Advance value is nothing but this amount minus margin. So bank would be ready to fund 75 against raw material, because 100 minus margin of 25. Then with regard to work in progress, they would be interested in lending 18.75. That's nothing but 25 minus 6.25. Against finished goods, it's going to be 56.25. Against debtors, it's going to be 75. So let's total this. It's going to be sum of all this, and total is 225. So this is what the bank is going to lend for the current assets of 325. So if you're going to show 325 worth of current assets, bank would be giving only 225 as what is known as drawing power. Okay, so this is the drawing power, but let's not conclude it like this, because this got to be compared with the cash credit that has been sanctioned. Okay, so let's see what is the cash credit that has been sanctioned. Let's say the cash credit that was sanctioned is 250 million, whereas the advance value what you have now is 225 million. Okay, advance value what we have now is 225 million. So now comes the exact role of drawing power. Drawing power is going to be the lowest of the above two. So you have to compare the cash credit sanction limit and compare that with the advanced value, whichever is lower. So you have to go by lowest, that is advanced value, and this is going to be the drawing power. It means only this fund will be released in CC limit, even if you have the sanction limit as 250 million. So this is very, very important role of drawing power. So this is going to be the scenario 1 when you have higher limit but lower advance value. So the drawing is limited to the lower advance value. So this is the best part of a cash credit because the account is getting monitored, it is getting controlled, or it is getting regulated. Or just imagine a scenario, let's say scenario 2. Okay, this is scenario 1. We'll have scenario 2 where we'll say that cash credit sanction limit is 200 million. Okay, let's say it's going to be 200 million. Then you have advance value. What is the advance value? It is 225 million. So now which amount will be released? Sanction is 200, but advance is greater than the sanction. In that case, again, it's going to be whichever is lower, that is drawing power is going to be whichever is lower, that is it's going to be this 200. So even though if you have advance value, that amount cannot be released because the sanction limit is only 200. So this is the exact role of drawing power. Now in this drawing power calculation, we have to keep two more things in mind. When the raw material are taken into consideration, we have to ensure that this raw material stock includes or does not include any unpaid materials. Because it is possible that you purchase raw material on credit and you don't pay for it, but you keep it in inventory and show it to the bank and get loan. That should never happen. So if there are any raw material included in this for which the amounts have not been paid, it means they are still on credit, then they got to be deducted. Okay, so let me just introduce two rows. So here I'm going to say less raw material purchased on credit. Let's say of this 100, I have raw material worth around 40 which are purchased on credit. It means the net raw material I should consider. Okay, net raw material stock which I should consider is only 100 minus this 40, that is 60. Okay, so here when I total, it should be only 1, 2, 3, 4, these 4, because this is net figure. Okay, and with this net we should add all the 4, and here we have. So let's shift the calculation from here to here. That is 25% margin, and margin amount is going to be 60 into 25% 15, and the advance value is going to be 60 minus 15, 45. So if you notice, the advance value has come down. Earlier advance value was higher, okay, but now it has come down to 195. And if sanction limit is 250 and advance value is 195, then drawing power would have been, will get reduced to 195. And in scenario 2, again, when the sanction is 200 and advance value is 195, we have to go for whichever is lower, that is only 195. So that is one critical point that we have to keep in mind. And again, with regard to debtors, you cannot include all the debtors in your stock statement, because at the time of sanctioning the cash credit itself, bank would have stipulated a condition that debtors which are only fitting in the working capital cycle. Because in the earlier sessions we have said the company would have the practice or the company may have the practice of giving 1 month credit or 2 month credit, and that should have been accepted by the bankers, and only those debtors should be included in the statement. So let's say the credit period is 90 days, and this 125 million includes 25 million worth of debtors which are above 90 days. Then those got to be excluded. Okay, so from this 125, I'm going to subtract 25 million worth of debtors because they are above 90 days. Why I'm removing? Because the bank has accepted only 90 days as the credit period. So what is happening here? Debtors is becoming 100, and if you notice, the advance value has come down. Earlier the advance value was 75, but now the advance value is only 60. So accordingly, the advance value is coming down. So drawing power will also come down.
Thank you for watching this webinar. I am sure you have derived value from this webinar. And if you wish to learn more, I have some good opportunity for you. What is that? Check out.
It is this Credit and Financial Analysis Mastery course exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies, and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1499. So aggregate price should be 7495, but you are not going to pay that. For you, it's just rupees 2499 for 1 year access, or rupees 4999 for lifetime access. And it is not yet over, you have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over, you also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 plus 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course you will understand what is working capital, what are working capital credit facilities, and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 plus 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2499, lifetime access rupees 4999. Not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis, various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about collateral securities, where you get knowledge about collateral securities. So overall it's 15 courses of value close to 22,485. It's 1,000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description, where without using any discount coupon code you can enroll at this discounted price, because it's a discount applied link. And not yet over, you're also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You're going to get access to various financial ratios ebooks, financial management related ebooks. You'll get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.